presentation contains current opinions of Moe Javaid, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone and welcome to the Compact Market Wrap Weekly Update for May 27th, 2026. I'm Moe Ansari, President of Compact Asset Management, joined by Javaid Ansari, Executive Vice President. We are going to talk about the markets, what happened last week, what to expect this week, and don't forget to subscribe to this channel so whenever I post an update, and there'll be a lot of charts that I will talk about that you can really see those when you go to the YouTube update. But go to compact.com, click on Insights, and you can see that, or just click on the subscribe button, and whenever we post an update, you'll be notified. If you need help with your portfolio, just give us a call at 800-388-9700, or you can send us an email at invest@compact.com. We'll do a free analysis of your portfolio, show you where you're headed, what you're trying to accomplish, and give you some ideas what to look for and what to look out for. Javaid, starting with the numbers. Also, first in housekeeping note, I don't want to forget this.
More than housekeeping, this is a big announcement.
This is a big announcement. Feroz, my brother, who's worked with me for the last 25 years, a lot of you know that. He's also adjunct professor at UCI Irvine, University of California, Irvine, teaches the finance class there. He has just put out a new book, Wisdom and Wealth. It's a great book. I mean, it gives you ideas how to live, what you're trying to accomplish, how to combine wealth with wisdom, or wisdom with wealth. And it's just, it sort of gets you thinking out of the box, and it really strengthens your purpose, how to build financial freedom. And it will be released July 14th. You can go to www.wisdomandwealthsolutions.com and you can pre-order it now. I think it's a great combination of living and learning and creating wealth, and how to combine all of that, how to live a much more purposeful life. So that book is coming out, Wisdom and Wealth. Don't forget it. Javaid, let's look at the numbers. Market continues to march higher and higher.
S&P up 0.91% last week, just a little shy of 1%, up 9.69% year to date. I like to go back and talk about January. Once again, January was up. January tends to kind of set the tone for the year. I know it was a little bobbly there in March and in April with the Iranian conflict, which I would say we're not quite out of the woods yet. I know there's a lot of kind of positive notes there, but until we'll look a little bit at that oil chart, see how things have progressed here just over the last week. But things seem to be improving. Oil was down big, I think, again today. And that's really continued to fuel the market. Dow was up 2% last week, 2.18. Russell up 2.75. Russell's up almost 16% year to date. And that's in spite of interest rates rising so far year to date. So I think small cap has really gotten a bid here. So I think that's great. I think they're going to also potentially see some improvements or some productivity gains from AI as well on the small cap front. Also, a little bit of that regionalism as things kind of get a little bit more regionalized. You kind of see a little bit more global tensions, not only in Iran, but tariffs, all these other things that have been going on over the last couple of years have kind of reshored a lot of things, and the Russell's benefiting from that. EFA up 2.2%, but one of the things I want to highlight with EFA so far year to date, only up 8.56, so not up as much as the S&P. So that was the big kind of story for the first couple of months. International is really outperforming, but particularly that the situation in Iran, it's causing a lot of more disruption in Europe than it is in other places around the world, and you're just not quite seeing that growth acceleration come out of particularly Europe going forward, and that's really kind of dragged down EFA overall. You compare that to emerging markets, up 1.11% last week, and up 21% year to date. I want to caution, though, a little bit on emerging markets.
Why is that? I mean, it's up 21%.
I know, we like up 21%, we'll take it. But
exactly.
If you look at the holdings within the emerging market index, so the biggest holdings are Taiwan Semiconductor, Samsung, SK Hynix, which these are all AI trades.
These are just chips, basically.
Basically, exactly. It's semiconductor chips. So
Right.
you think you're getting that international. I've looked at another emerging market ETF that kind of has more of India and China. It's actually down 25%, down 25%. So you have a gap of almost 50% of some of these emerging markets, particularly India and China, haven't quite gone up as much, or actually they're going down so far this year. And it's just a couple of these, like it's all AI, it's all the semiconductors. It's really pushing up the S&P. A couple of stocks have really pushed up the S&P this year, and then you're also seeing that with emerging markets. You have to be a little cautious there, I think, with emerging markets.
So you're saying this is not really emerging markets right here?
No.
MSCI EM, it's not emerging markets, basically buying 3 chip stocks. That's what you're buying.
Yeah, it's pretty around 20% of the entire index is in those 3 stocks. So I think it's really important just to understand what you're buying. Everyone talks about emerging market index. Am I getting that growth of India and China? Not really. You're really kind of speculating on AI. So just be aware of that, I think, when you're looking at reallocating. NASDAQ up slightly last week, up 0.48 and up 13.62, so continuing to lead the way. But overall, as we kind of said in the last couple of weeks, diversification, everything's up, right? So you can have it. Now is the time to diversify. You have some small cap, you have some international, you have some NASDAQ. Everything is up. Everything is doing well. And now is the time to continue to diversify your portfolio because everything is still continuing to do well. You're going to make money. You don't have to have it. I know a lot of people are starting to look at DRAM, get into the semiconductors. Now, there's a lot of talk about SpaceX and the upcoming IPO. Sure, buy a little bit, 1%, 2%, 3% if you can get an allocation in your retail account. But I wouldn't be putting 20%, 30%. And if you're fortunate enough to have 30%, 40%, maybe it's the time to just kind of slowly take a little bit off the table and diversify.
Utilities were the big sector last week, healthcare, real estate. What happened to technology? What happened to energy?
Yeah, just taking a breather. I think,
Okay.
it's been, you still look at energy up 33% for the year, technology up 18.4%, so those are the 2 leaders for the year. So you're just going to see a little bit of back and forth. So I think particularly as interest rates really rose last week, put a little bit of a damper on the growth story. Now that interest rates are coming back down a little bit this week, some of that growth is coming right back.
They've come down big, especially today, and oil came down big today, below $90 a barrel. I don't know, it was because of a statement by Iran that they have got a memorandum coming out, but the president said, no, that's not it. So I think it's going to go back and forth. But what it does is reduce the possibility of hostilities starting again. That's basically. But we're still firing at each other. There's still
some bombing going on.
But it's still a ceasefire. So everybody says it's a ceasefire, but a little bit here and there.
Once again, I think all of the rhetoric, and everyone likes to look at the headlines. I really do feel the ball's in the United States court in the sense that unless they're willing to really kind of give Iran everything he wants, nuclear program, unfreeze some assets, all of these other things, I don't know if there's, Iran really wants to kind of give up the leverage they have at the moment. It's very their economy is suffering dramatically because of the blockade.
But they don't care about their people.
Yeah, exactly. So that's why I think it's still very much, it just depends how much the administration is willing to give up. And I think the pressure is continuing to mount, specifically on the Republicans, particularly with the inflationary pressure. A lot of the core voting bloc is not very happy. Affordability is the lowest it's ever been in terms of housing and now gas, et cetera. So I think all of that's not playing very well for the Republicans. Yet, if you look at the Senate, a lot of the senators are also kind of not, the Republican senators don't want to give away the House here. They said, hey, we started this whole thing. Let's try to finish it or get something out of it. Otherwise, what was the point?
Yeah, the Iranians want the nuclear bomb. They want the Straits of Hormuz. They want all their assets freed. And they want all the sanctions lifted. That's all they want, nothing else. But that's everything and anything. Really, they've thrown that in the kitchen sink.
And I think, if they end up getting a lot of that, then U.S. technically kind of lost the negotiation and the whole conflict here going forwards. But I think even if that situation, who knows what the long-term implications are for that. If there is an opening of the strait, that's good economically in the short run. There's no doubt about it. It's going to take anywhere from 4 months to get it back up to 80% oil capacity really won't be back up to full capacity. And that's if the Straits open today. We won't be up to full capacity until early 2027. So you can't just, it's easy to turn off, but it takes a while to turn back on, as we kind of saw during COVID as well. It's easy to shut everything down, but to get everything going again, it definitely takes
Especially
some time.
oil wells and oil refineries, and all of them have been damaged, a lot of it. So getting oil up and running, coming out of Qatar, Iraq, Saudi Arabia, UAE, it'll take time. It's not going to be that you turn on the switch and there's oil starts to flow. So it's going to be a while, and that's why I think oil prices, they came below $90 a barrel today. It's 96 last Friday, 96. It's below 90 today, 89 and change. So how far down does it go? I don't think it's going down to $50, $60 a barrel like it was before the war started. Maybe we get down to 80, best case, maybe a little bit lower.
Well, this is why I also like to look at the futures, because the spot price can go up a lot, come down a lot. But really, it's what the futures don't move as much, which is that DBO ETF. That's what we're continuing to track, because it's looking out that next 6 months. It's trying to really handicap, okay, where are prices today, but most likely where are they going to be for the next 6 months, because that's really what's going to affect the economy. And so far, they've come back down, but we're nowhere near. We'll talk about some of those
Yeah, I think the
levels on
DBO
chart
chart is at a critical level today. It came down to the 50-day moving average. We'll talk about that. Interest rates, 4.56 for the 10-year. It's down to 4.48 today.
Yeah.
So it's down. This was last Friday when they closed, but it is down to 4.48. So you were talking about how it's a great opportunity to buy bonds. Why was it a great opportunity? As interest rates come down, the value of bonds goes up. Plus, when you buy bonds, you lock in a certain interest rate. The higher rate you lock in, the better off you are. And that's why you've been talking about it for the last 3-4 months.
Yeah, particularly if you have
3-4 weeks.
If you have a lot of cash, and you want to basically move that cash a little bit up the risk spectrum, not a lot. You can buy some investment grade corporate bonds. Right now, you can see the yields were close to almost 5%. They're 4.8%, but you're 5% on 5.26 on corporate bonds, even almost 5.5% on corporate bonds here, and they've done pretty well. They're up 6.3%. Not for 1 year. Year to date, they've been kind of flat once again because interest rates have gone up.
But you're still getting this 5.26 interest.
Yeah, and you don't have to necessarily buy the stock market. You can even buy high yield. You're going to get 7.4. No, that does have some stock market risk, but you're still going to get a nice coupon there at 7.4%.
Right.
You can buy some bonds just going out 1 or 2 years. So those are things that we kind of spiked up. We came back down. So now we're still not. I like to see it below 4.4. That's kind of my break even of when we're kind of in that kind of not too hot, not too cold. We're still above that at 4.48 today.
Right.
But we'll see. We talked about last week, there's a lot of deflationary pressure when it comes to shelter, and particularly now the tariffs waning.
Yeah, interest rates usually go up when there's a lot more growth. The economy is growing too much, and the Fed is stepping on the brakes to slow down the economy. That's not the case. Yeah, economy is doing great. But I think it was a combination of fear that inflation is going to take off. And that's why interest rates went up a lot. But I just don't see inflation taking off. Yeah, because it could see a spike, temporary spike because of oil prices. But if we see oil prices starting to come back down to $80, $75 a barrel, takes away a lot of the pressure.
Well, and I think it also somewhat was with Kevin Warsh being nominated, right? Kevin is the new chairman of the Fed, Chairman Warsh. He basically is kind of put in the position to be a dove, right? To cut rates, right? That's what the president wants. But when you look at the Fed minutes, which are the notes from the previous meeting, it was pretty contentious around cutting rates, but potentially really starting to discuss not only taking away the easing language, but start talking about we're equally balanced or potentially raising rates. And so when the market saw that the Fed is pretty divided and it wasn't just going to be just kind of a Warsh washover in terms of just going in and cutting rates day one. I think the next meeting is June 17th, so a couple of weeks here. But nothing's really expected for that meeting. The earliest I think we even could see a rate increase would be July. But if we start to see easing oil prices, then I think the Fed can just kind of remain put.
I think the bond market, it
wanted to test them a little bit.
It was talking about 2 interest rate cuts by the end of this year, at the beginning of the year.
Yeah.
Then it said, okay, maybe no interest rate cut. Now they're talking about interest rate increases. I don't think we get any increases. I don't think we get any cuts. I think we're going to stay sort of back and forth in this 4.4 area, maybe a little below that. And I think market can handle that. As long as we don't go above 5, we're okay on the 10-year. If we start falling below 4, then it could be a problem because why are the interest rates going down so much? That's maybe the economy is slowing too much or whatever it may be, which it is not.
Yeah.
I mean, the economy is just continuing to chug along.
Yeah,
Even it's seen all these the reasons why the economy should collapse, why the consumer would not spend any more money. They won't have any more money left because they'll all put it in their gas tank, and so consumer is still spending. That's the biggest thing. The consumer is still spending, and you see retail sales, they're still holding up. Interest rates, this is a real yield in blue, and you can see that it took off. But this is the inflation breakover. What is the expectation? It took off in March and April.
Yep.
But then you can see it's coming down hard.
Yeah.
That's the black line.
Yeah, so basically real yields go up when there's expectation of potentially more growth going forward, and so you want to price that in. And then particularly with inflation coming, break-evens coming down, that's kind of a positive signal in terms of the rates are rising for the right reason. Rates are not necessarily rising. A little bit of inflation worries baked in there, but now specifically, hopefully we are going to continue to see very solid GDP growth. You look at some of these GDP numbers, now they're starting to talk about 3% maybe for the year, which is way above the 2%. So, I think that's really necessary given what the earnings expectations are here going forward. So we'll see, how that all plays out, but not really. Once again, we like to look at the bond market to give us those signals of how good things are, or how bad things could be. I think the bond market is definitely telling us right now things are good. And so don't really, second guess it. Just continue to know stocks are highly valued. There's no doubt about it. Earnings need to come forward, but everything is pointing towards that the earnings are going to come forward. So
they've been coming out better than expected.
Yeah.
So that's the thing, that the earnings are still going up. Their home sales were up. That was good. Housing starts fell.
Yeah.
That means they're building less homes.
And that's why I still like real estate. If you're able to even acquire it, real estate, if you look at the amount of homes that are being built, there's just not enough supply for all the demand out there. And I know that's just continuing to push up prices, make affordability worse. But as far as an asset class, right, for an investor, you like supply, you like tight supply, and you like a lot of demand if you're able to have some of that supply in your portfolio.
Not a lot of economic data coming out this week, durable goods, nothing dramatic coming out.
No, I think we're just kind of, now we're through earnings. A lot of the news around the Fed has kind of calmed down. Markets is kind of, I think the next, everyone's kind of getting excited for the SpaceX IPO, which is coming, potentially in middle of June. I think the roadshow starts on June 8th. My kind of target IPO date's somewhere around June 22nd is when we get that. So that's going to be a big kind of test for the market, because when you look at the cash flow, there's a really good article in The Economist talking about just all the different mechanics behind SpaceX, but basically it's Starlink that drives all the profitability, and then SpaceX, where they make the rockets, is a big loss leader.
It's not making any money. SpaceX isn't.
They're blowing through money. That's what you do when you
the
build
rocket
rockets.
part.
Yeah, the rocket part.
When they have Starlink, which is the internet part of it.
Which makes a couple, but when you look at the valuation,
It's crazy.
Tesla's valuation is really high. SpaceX is on Mars already,
Oh.
so you got to be a little cautious. But I think that's going to be interesting. There's a lot of retail investment, retail kind of excitement. I think SpaceX does own that space when it comes to space exploration and ability to put satellites into orbit. So I think that's interesting. It's just I think that's the difficult thing of this market, is you are paying premium prices. And so if everything doesn't go to plan, you're going to get hurt. So if everything continues to go to plan, which it is, it's all good. But that's why I think, you can take a little bit of a flyer, if you will.
Right.
But don't be going, putting all your money in it, right?
The difference here between the dot-com bubble that I saw in 1999 was it was all vaporware. That this new software is going to come out, or this dot-com.
Yeah, it was a promise.
It was a promise. The difference, SpaceX is a promise also.
Yeah.
a grade. But they have real rockets.
Exactly.
And they have real stuff. They have Starlink up there.
That generally works better than anything else.
That's the thing. It's still out there. It's not making a profit yet,
Yeah.
but it could make a profit. We don't know that. That's all the projections that they have out there. So it's not as risky as a .com, which was nothing except a promise.
Yep.
But it's not Google, which is real profits that you're generating, real profits and making real money quarter after quarter. Nvidia, which is just blowing away earnings, and then people come out and say, "Oh, it only made this much. It just beat earnings by 50 billion or whatever they beat it by," and they're saying that's not happening yet. So it's somewhere in the middle. So as you said, it might be somewhere to take a flyer on, but you don't put your whole portfolio in it. Looking at the technicals, we continue to move higher. This was looking like a fifth wave. Now it seems like we completed a pullback at the end of March. That was a fifth wave, wave 1, wave 2, wave 3. And now the wave 5 target, if this is a wave 3, is 7,700. Then we get a pullback, a fourth wave, and then a fifth wave down to about 8,000, up to about 8,000 is what it's looking at, the projection on the daily charts.
Okay.
The weeklies are even looking, even though this was the target from the third wave, that we were looking at 7250. Remember we were talking about that?
Yeah.
So maybe you'll get to 7250, who knows? Well, we're at 7,500 today, and that's where we are. And the target on the weeklies, the fifth wave projection, if we get an extension of the fifth wave, the Fibonacci projection, 8,200. That's what it's. So, markets do not have to top out. That's why I keep saying trying to pick tops and bottoms in a market can be hazardous to your wealth. Don't try to guess where the market is going. It can't go higher because of the Straits of Hormuz. It can't go up because of oil prices going up. It can't go up because of inflation. Market can do whatever it wants to, whenever it wants to. The trick is to get yourself out of the way, get your biases out of the way, get your fears out of the way, and stay with an allocation that is set up for you with your goals and your financial objectives and your risk tolerances. It's hard.
Yeah, it's very hard, and I think the key thing is don't have a lot of cash, right? If bonds, you're having an opportunity to buy bonds. You had an opportunity last week. If you have stocks, that's great. They're doing well. Make sure you're just not over concentrated, but stay invested is what we're trying to say. And know your risk tolerance. Know how much you can handle. There's going to be bumps. Right now, everything is good. It's all great. We'll continue to go. I do want to talk a little bit about what I think is going to eventually put a kibosh on the bull market.
I don't like to hear anything about a kibosh on the bull market.
Well, but I don't think they're happening anytime soon.
Okay, then go ahead. Let's talk about it.
So the first one is the Fed. The Fed, there's the old adage, bull markets don't die of old age, they die because the Fed kills them, right?
Right.
And particularly now, if we saw this little scare last week of interest rates go higher, but it's coming down. We're not out of the woods yet, but we'll see. But it seems like there's still that disinflationary pressure from shelter, from tariffs kind of diminishing over time, that rates should still continue to come down. So the Fed doesn't need to jack up rates, 4, 5, 6, 7 times. I'm sure you remember, of course, the 80s, right? Volcker had to come in and put the economy, on its knees to bring down inflation.
Right.
That doesn't seem to be in play right now, which is good.
Right.
So I think the Fed isn't necessarily going to pour cold water on the party anytime soon. The other one that I think ultimately can also break the back of this bull market is potentially some sort of regulation of AI. As AI, I think, becomes more disruptive, particularly for employment. Where now humans, for the first time, are looking at technology not only as a tool, but actually as a competitor in terms of potentially having the ability to take their jobs. So if you're not able to compete with the computer, which not a lot of people can when it comes to the services, it's going to be rather disruptive. But I think that whole process is going to take time. Corporations have to implement the technology, has to work well. They have to then let the people go. The people have to be disgruntled. It has to kind of maybe slow down in the economy. The politicians then need to kind of react to that. And then, they get voted in, and then they pass some laws to then ultimately regulate it, right? So that can all happen.
But it's long term.
That's longer term. It's not happening overnight. I don't even think it's happening even if we had the change in the House with the potential Democrats here in the midterms. I think we're at least 2 years away, from that type of more regulatory environment. Or if AI kind of goes rogue, kind of nuts, if something major happens really quickly, then that might be a black swan event that causes a lot of people to decide to say, wait a second, we need to put a pause on this. But as far as the disruption to employment, I think that's going to take some time as well. And so those are the two things that I'm, more of those more cyclical secular trends that we're watching. And I don't think either of those are in play for the time being.
I was looking at all of this stuff, and it reminded me, I read a lot about the 1920s, when electricity came, when we saw automobiles come, when we saw transportation just take off, and how it changed society.
Yeah.
And we said, oh my God, all the people who were making stagecoaches were gone because everybody wanted a car.
Yeah.
The automobile came along. But all the people who lost jobs there are a lot more jobs created making automobiles. All the stagecoaches are not being made. There are more jobs created making tires.
But I get that logic. But my thing is I think this time is actually different in that those were all tools to enhance the human capability, right? The human.
What is AI?
I think AI is going to replace the human capability in a lot of things. So it's not. So that's my point. Is that it's not like humans are going to be using AI. AI is going to be using itself. So there's no human to benefit from the technology, because the AI, you don't need a human. It's a computer, and it's basically being run by a data center. And there's a couple of engineers. The computer's actually training itself, right, with a lot of these agentic AIs and how it's going to ultimately compete.
But you still need somebody to tighten the bolt, or there'll be robots.
Yeah, there'll be a couple, but that's. I mean, how many people are going to be capable of tightening the bolts on the actual machines? Yeah, a couple, but I'm talking about the service industry, right? That's what I'm really kind of all of this. If you have a trade, if you work with your hands, you have some artistry, and that's not going away anytime soon. But those are much smaller components of the overall economy. I'm talking about white collar, middle management jobs that are being done on a computer day by day. And those are something that I kind of worry about. And I think it could benefit shareholders, right?
Right.
Because companies are still making money.
Right.
But what
More
is
money.
more money? Yeah, and that's what we're seeing with these earnings valuations and profits. We're seeing record profit margins of the S&P 500. But it's just kind of similarly to globalization with China, and we shipped all the jobs off to manufacturing off to China. And we said, hey, sorry, guy, you missed the boat, and we didn't train that guy to go and become a computer programmer. Well, what are we going to do for all these middle managers when AI comes and gets their job? How are we going to manage that as a society? Now, once again, much bigger type of topic here, and maybe doesn't even have a negative effect on the stock market. But it's just something to, I think, be aware of as we continue, and we'll see how that kind of wind blows politically as things progress.
It's something to think about. And again, these are things that we think about longer term, how they're going to impact you as an investor, how it's going to impact us as money managers, and what are we thinking about, what are we doing? Just thinking about one trade or looking at this, we want to think of the bigger picture also, and never lose perspective of what we're trying to do, where we're headed, and how do we get there. That's our job here at Compact. If you want to come and talk to us about it, give us a call. We'll be more than happy to sit down, chat about it, tell you our views, what we're thinking, where we're headed, how we can help you get there. Looking at the weekly NASDAQ again, this is the fifth wave target on the upside, looking at somewhere around 28,000, a little bit below that, or an extension closer to 29,000. We are at 26,500 today.
So the gist is you think we have more upside?
Yeah, that's what it looks. 26.6 is where we are today. So that's where we are. Small cap ETF continues to move higher. Looked like it was coming down last week. So it looks nice, making new highs. Extension
Also
on
in
the
the
upside.
fifth.
Yep. This is the international, the MSCI. These gapped up today. This was interesting. It left a tally gap this week.
This is a week, yeah.
And a weekly chart from last Friday's close to this Monday's open. Again, target is here, and looking like it wants to move higher too. So everything looking good. This is oil, a daily chart of oil. And this is where it is today, right here.
Yeah.
2109 is the 50-day moving average. Today we closed at 2119, right at the 50-day gap down. Today, big gap lower. This was the close yesterday. This is the high today. So this is space right here. If we break below here, that could be a good sign. Break below 2100.
Yeah, I think we break below that. I've always said we're out of the woods completely once we're below 19. Now I think the market, is kind of getting used to it, so maybe it can tolerate prices, not where we were a week ago. That's why we saw interest rates, I think, a lot higher. But now that oil's come back down, interest rates have come back down, so it's not great. It's still a headwind. I think it keeps the Fed from definitely cutting rates,
Right.
Anytime soon, as long as oil stays where it's at. So that is not kind of extra fuel that we can get, on the fire, but it's headed in the right direction. It's just something we're going to need to watch, of course.
And it's
really
day to
closely.
day, headline to headline. What did President Trump say?
Yeah, if there's a flare up, if they attack some infrastructure in the Middle East, it's going right back up again.
Right, that's it. Again, this is the red means they close right here. This is the 20-week moving average. This is a weekly chart, 2079. We're 2119. So right at the support area. We'll see where we go from here.
Yeah.
Interest rates hit this high.
Yeah, so is that kind of that gap up and then a couple of days there and then the gap lower?
Island top.
You think it's an island top?
Yep, it gapped up here
Yeah.
and gapped down here.
Okay.
So this is, when you get gaps up, that means there's extreme fear that the rates are going higher. All of that dissipated, and we're today below the 20-day moving average, which is 4.482. We closed at 4.481, just below the 20-day moving average.
What I don't want to see is this chart, come down a lot. I think, once again, we're right around this 4.5, 4.4. It's not too high. It's not too low. It's kind of just right.
I think we're going
and
to
so
set
we're
up a
kinda
new range in this bond market. right?
slightly higher.
Slightly in this range. That's where we're going to, well, probably in here.
Yeah.
That's where we're just going to go back and forth between 4.5 and 4.3.
Yeah.
Instead of here we were between 3.4% to 4.3, we'll just set a higher band here.
Back and forth on rates is what I love to see.
That's what we, gold ETF, gold has sort of lost a lot. As I said, I thought this was a high right here and a failure on the fifth wave back up. And we're drifting very close to the 200-day moving average now, which is 401 for the GLD. We're 408 today on the close.
I think as long as, once again, until we get some complete resolution in Iran, it's putting a lot of pressure, particularly India is seeing the rupee, depreciate a lot. And so that's putting a lot of pressure on them. So they're having to liquidate some gold, et cetera, to support their currency. And so I think, the more we just kind of have this stalemate in the Middle East, it kind of just has that downward pressure on gold.
Which is something different. Historically, usually when you saw international geopolitical problems, gold used to go up.
Yeah.
Now we're seeing the opposite, because what has been happening in the last couple of years, central banks had been buying gold. Now all of a sudden they've got to support their currencies, as you mentioned, and support their economy. They need more cash.
Yep.
So they're selling gold instead of buying gold, a lot of these central banks, and that's seen the liquidation, that's seen prices lose over 20%.
Well, and the other thing we mentioned about emerging markets, emerging markets are a big driver of gold.
Right.
In terms of China and Indian consumers. They consume lion's share of gold. It's a big part of the culture in both those economies. And they're both not doing well. From a kind of consumer perspective, they're seeing a lot of pullback, a little bit of volatility there. So I think that's also the two main drivers of demand. Central banks and emerging markets are not really driving gold. So probably isn't getting out of its own way here for quite some time.
HYG, this is the
Trend just still trending up nicely. A little bit, today it was very minor. HYG was down, AGG was up a little bit today. So don't like to see that, but we'll be just kind of watching. But overall, you basically look at it since the beginning of March, when the actual situation started.
right here.
HYG has been outperforming to the upside. So the bond market the entire time has told us, hang in there, don't worry. Yes, we saw a 10% correction in the S&P, but once again, the bond market didn't bat an eye. And so, as we continue to move forward, we'll continue to use that as a good guiding post in terms of where we stand.
This yellow line is the relative strength of the HYG, which is the red one, and the green one, which is the government bonds.
Yeah.
And these are high yield bonds, and tells you when there's economy, everybody feels good. This one goes up more, and this yellow line is moving up. When everybody's worried, that's when we saw the war start in February. You can see that this yellow line was going down.
But even then, I'm not as much worried about it when the yellow line's going down if the bonds are also going down. What I get really worried about is when AGG is going up and HYG is going down.
That means when the red line is coming down and the green line is going up.
That's our signal for the recession. And we haven't seen that. We see these kind of dips where there's a little bit of risk off, so high yield's going to underperform to the downside, but bonds are
they
taking
came down
a hit
together.
too. Yeah, exactly. So
and then it took off to the upside. And
Yeah.
that's always a good sign.
exactly. So great indicator. I think it's really helped maintain the course through all this volatility. We've had a lot of volatility. We'll continue to have volatility, with the valuations where there are, but everything's still looking pretty good. Prices are near all-time highs, so we'll take it.
Those are our thoughts. Those are observations for this week. Again, if you'd like to subscribe to this channel, click on the subscribe button, or just go to compact.com, click on Insights, and all these podcasts and YouTube updates, everything is there. If you need help with your portfolio, if you just want a second opinion on your assets, give us a call, 800-388-9700, or send us an email at invest@compact.com. And don't forget, the book is coming out, Wisdom and Wealth. That's what it is. It's all about that. Wealth, yes, but wisdom. If you don't have wisdom, you have wealth. The wealth will go away. As the old saying goes, a fool and his money are soon parted. So you got to have wisdom to really create wealth.
And I really like to, I've of course read the book and been a big part of working with Feroz on the book. He did the lion's share. I just kind of help edit it over time. But these are really kind of topics where we really are trying to take a holistic approach to wealth management. We're really trying to understand, okay, not only how are we going to get there, we want to increase your net worth and make sure we're doing efficient tax planning and financial planning, but also the why. Why are we doing this? Looking at a lot of the why centers around relationships. There's a lot of wisdom there around relationships and how you orient yourself around the world to see things objectively so you can make better decisions. And I think this book specifically was written by Feroz for his two sons and for the next generation of the population, where he could really, in one book, kind of put all of his knowledge as a wealth advisor, as a professor at UC Irvine, into one book in terms of financial, personal wealth, as well as wisdom around what to do with your career and your spouse and other things around these really important decisions that really dictate your life. It's all within this book. So definitely check out the wisdomandwealthsolution.com. There's an online assessment there, so you can kind of see where you're at in terms of your wisdom and your wealth. A pretty cool assessment that we do with all of our new clients here at Compact. And so you'll hear more of this over time. It's kind of a core thing, a core kind of tenet of what we believe here at Compact. And we might even have Feroz join us on the YouTube here and talk about it in a little bit more detail in the next coming weeks. So stay tuned for that.
So great book, folks. Really encourage you to go and go to
Amazon, pre-order it.
You can go to Amazon and pre-order it, Wisdom and Wealth Solutions. Looking at that, those are our thoughts, those are observations. We will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Javaid, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.